I'm Michael Dillon. In this videotape, we're going to cover how to avoid drawdowns. What are the different price patterns that cause us to have drawdowns? What the effects of different trading systems are. We're going to cover a moving average stochastic system, a triangle trading system, and the downchain trading system. And we will also cover many trading ideas that should help you greatly in bettering your trading results. Markets fall into four categories, and these four categories are trend waves, correction waves. Correction waves are further divided into simple correction, complex correction, and sideways, choppy markets, trend reversal. We'll cover a few of these right now. During a trend, there are many sizes of correction waves. Here we have a very small correction wave. Here we have a mid-sized correction wave. Here we have a big correction wave, and then the trend continues. During the trend, you will also experience sideways markets. And the waves with the trend, I call them trend waves, and the correction waves, I call them corrections. Here we have a big trend wave, and here we had a small trend wave followed by a correction. This is a sideways market. During the uptrend, the market enters into the sideways pattern. And this is when most of the losing trades occur. Markets are constantly changing. We have big corrections, mid-sized corrections, small corrections, big trends, small trends, sideways choppy markets, small sideways markets, trend reversal. It is because the market constantly varies that we have so much difficulty in successfully trading. Various price swings create each phase of the market. This is the correction phase, this is the trend phase, this is the sideways phase, and this is the trend reversal phase. Choppy markets of 2 to 4 months occur regularly, but it is rare to get one that is this bad. This choppy market had big price swings and lasted over a year. This was a gold chart, and this is where trend following system will get chopped into pieces, and many other ways of trading will experience substantial drawdowns during choppy markets like these. The small trend waves, big correction waves, big trend waves, and small correction waves all make up the overall big trend. In other words, during the big trend, we have many small trends, a mid-sized trend reversal or big corrections, and trend waves. If all corrections were similar in size, trading would be very easy. Here we have during an uptrend, we have a simple correction. And this is correction wave A. And then the market continues to go up. Here we have a slightly more complex correction wave. The trend is going up. We have a correction wave A, uptrend swing B, which does not make a new high, and a correction wave C. So from this point right here, all the way down to here, it's correction. And this correction is what we call ABC pattern. And then the trend continued to go up. Here's a slightly more complex correction, A, B, C, D, E. And then the trend went up. And here's a very complex correction pattern. And these correction patterns to an untrained eye is very confusing in the charts. This is where people get confused, wonder if the trend is still up. Here's the correction A, B, C, D, E, F, G. And then the trend continues to go up. We're going to explore more of the meanings behind these price swings during the correction phase. All these patterns are occurring during the correction phase. Sideways markets are often part of the trend. Here's a simple correction. This is very easy to trade, but when the market starts into the sideways pattern during the trend, that's where trading becomes very complicated, and we're going to show you a way to trade without getting caught in this choppy market. Sometimes sideways markets can lead to a trend reversal. Here treasury bonds have been going up, then they enter into the sideways pattern, and they break on the downside, and the trend reverses after the market goes down substantially. Here's a simple correction wave, and then market went up. Here's also a simple correction wave. This correction wave had a ABC pattern in it. Let's draw a line to see this clearly. Here's the A. Here's a one-day B pattern. and then here's the C. So you have an A, B, C, and the market goes up. This correction wave number 3 is much more complex. We have a downswing, an upswing, a downswing, upswing, downswing, upswing, downswing, and finally the trend might start going up. And these complex corrections is what creates what we call the triangle patterns, which we're going to explore later and give you some test results. These two parallel lines represents the size of this correction here. The trend was up. All these waves that are occurring are part of the correction. They're not part of the trend. So the correction ends here, and then the trend starts to continue up. And we're going to learn later how to use small pivots for trading. So let me quickly summarize what we have covered. Here's a trend wave. Then we have correction wave. Correction wave comes in 3 patterns. A simple correction wave, market goes straight down and then up. There is complex correction waves where market has an A, B, C pattern. And then there is sideways correction wave. Then there's the trend reversal. And then there's choppy markets when markets zigzag in erratic way up and down. And we have also learned about the low pivot points and the high pivot points.